Short selling strategies in the stock market. The stock market offers a dynamic platform for investors to generate profits. While traditional investing involves buying low and selling high, short selling offers a contrasting approach. This strategy allows investors to profit when they believe an asset's price is about to decline. Let's delve deeper into the mechanics and nuances of short selling in the U.S. stock market. What is short selling? Short selling is a trading strategy where an investor borrows a security, usually a stock, sells it on the open market, and then buys it back at a later date, hoping the price has decreased. The profit is realized from the difference between the sell and buy prices. This strategy is particularly attractive during bearish market conditions. How does short selling work? Borrowing the security. The investor borrows the desired stock from a brokerage firm. Selling the security. The borrowed stock is sold on the open market at the prevailing market price. Buying back the security. If the stock price declines as anticipated, the investor buys it back at a lower price. Returning the security. The repurchased stock is returned to the brokerage firm and the investor pockets the profit. Short selling strategies. Fundamental analysis. This involves evaluating a company's financial health, industry position, and future prospects to determine if its stock is overvalued. Technical analysis. This method uses historical price charts and patterns to forecast future price movements. Macroeconomic analysis. Investors assess the broader economic environment, including interest rates, inflation, and geopolitical events to identify potential market trends. Sector analysis. By analyzing specific industries, investors can pinpoint companies that may underperform relative to their peers. Risks associated with short selling, unlimited loss potential. If the shorted stock's price rises unexpectedly, potential losses are unlimited. Liquidity risk. Smaller cap stocks may have limited liquidity, making it difficult to close a short position quickly. Borrowing fees. Brokerage firms typically charge fees for borrowing securities. Market risk. Unforeseen events can cause sudden and sharp market movements, adversely affecting short positions. Conclusion. Short selling can be a powerful tool for generating profits, but it's essential to approach it with caution. The strategy involves significant risks, and investors should conduct thorough research and consider consulting with a financial advisor before implementing it. While short selling can diversify a portfolio and potentially generate profits during bearish markets, it's not suitable for all investors. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.